Welcome back to Ignite&Scale, where we explore the key trends, challenges and opportunities shaping industries with experts who know the landscape better than anybody. Today, I'm excited to welcome a trusted industry contact and long-time collaborator, Owen Edwards, Head of Downstream Automotive at Grant Thornton. Owen brings an incredible depth of experience to our discussion, and today we're tackling the upstream and downstream prospects of the UK automotive market for 2025. Together, we'll unpack the challenges and opportunities facing the sector as it continues to adapt to changing regulations, consumer preferences, and global pressures. Owen, it's fantastic to have you on the show today. Thank you for joining us.
No problem, Mike. Thanks for having me. Appreciate it.
No problem. Well, let's start with maybe the upstream challenges then. I mean, if we reflect on 2024, we saw significant issues like plant underutilization, weak demand, some supply chain fragility. How do you see these trends evolving in 2025?
Yeah, so I think you're absolutely right. So 2024 was a really interesting year, and I think it was one of those inevitable years where, we're starting to see a lot of influx from, Chinese manufacturer supply chain, demand is soft and so on and so forth. So 24, and going into 2025, I think, demand is still going to probably look soft. So that's going to really affect the upstream and the downstream. But of course, we're talking about the upstream at the moment. I think the scenario is with that is you've got plants in Europe coming under significant pressure. So we're looking at utilization for America and Europe, which gives an indication of the whole of the world. And plants are around about 75%. Now, the reason for that is pretty straightforward. The first reason is that with the internal combustion engine, which there's slowly less of them being manufactured, you're starting to get diseconomies of scale, if there's such a thing. But basically, you're not getting those economies of scale that you're getting. So those plants are at 75%. And as you know, Mike, it's really, really tough to make a profit out of any plant or break even below the 80%. But then, of course, on the other side, you've got the battery electric vehicles. It's more efficient to make them. So you could get economies of scale faster, as you found in China. But the scenario is those economies of scale are just not coming through because there's just not enough throughput from the European and the legacy makers. So having those two positions, they've got to juggle those two positions at the same time, drive BEV sales, not just for the UK, because you've got emissions in the UK, you've got Europe and you've got it in America, but then, balance all of that up. And that's a really tough thing. And as you quite rightly said, we are starting to see some of the, some of the European legacy manufacturers saying, well, we have to close plants, we have to rationalisation. We're seeing some of the supply chain again affected by that. So if you look at Bosch, for example, they've reduced the number of hours people work a week, and just that rationalisation is going to need to take place, which is causing great disruption in the supply chain as well.
Yeah, no, absolutely. I know you spent a lot of time with a number of the Chinese brands, and they're clearly making waves in the market at the moment, and expected to make more waves in the UK market as it stands. No tariffs, but let's see. But with hybrids, extended range EVs, plans to establish more manufacturing in Europe. What do you think this strategy? What's the impact of this strategy on the broader industry in your view?
Yeah, so again, it's really interesting to see what initially what their plans are, and I think the scenario is they will, those that can accept the pain pressure of the tariff increases, like the BYDs, which is about 27.4%, they will accept that and they'll continue to push higher into the market because at the end of the day, you can't go to America because you've got 100% tariffs. Okay, so you take a slightly easier market where you've got between 27 and sort of 39, 46%. So I think they'll continue to push forward. It's a great market. I mean, you've got 15,000 units through cycle, 2 million of those in the UK. So again, the UK is a good place to be. It's right-hand drive, I know, so it's slightly more expensive, but fundamentally, there is still the opportunity for them to take advantage of right-hand drive across the world. So that builds up your units. But I think where we're going to start to see it is they'll clearly might have a slowdown due to the tariffs. So there's a possibility. They might have a slowdown as they try to grapple with their distribution network, which is absolutely key in Europe, to get the parts, especially in the after sales, to make sure that's right. You can sell cars a bit easier. But fundamentally, it then comes down to that distribution of parts and vehicles, which will be made easier once they start to manufacture in Europe. And what I think they'll start to do, as BYD has done, is you'll put your battery plant in first, because it's 50-60% cost of your BEV. And then after that, you'll start to follow it with your manufacturing facility. Now, where they put those is going to be an interesting one. And this is something that the UK government, I don't want to get political, and these are only my thoughts, not GT's, but I think the UK government should start to consider, well, actually, you know what? If we can do a bit of support here, it might encourage one of those manufacturers to come to the UK, where we do need about another 30 gigawatts worth of battery power in the UK.
Yeah, well, let's not get political, because I think this could be an extra long podcast if we do. But
yeah, of course.
moving swiftly on. I mean, in terms of the price points of these cars, particularly in the premium and SUV segments, what's your view? Are they still simply unaffordable for many consumers? Will that change significantly in 2025? How do you feel about the price points of some of these cars?
Yeah, and this is the thing that a lot of people aren't actually talking about. So you picked up a really, really good point there, Mike. You know, most people have sort of said, well, what's the volume? Where's the volume going? And all the rest of it. But I think fundamentally we should start not ignoring the volume, but keeping an eye on it. But then on the other eye aspect, we should start to then consider really seriously what the prices of these vehicles. You know, if you look at battery electric vehicles, they're very expensive. You know, they're 20, 30 grand more than the standard internal combustion engine. So one, you've got a more expensive mix of vehicles, battery electric versus ICE, but also ICE vehicles have gone up. Now, when we had hair, Mike, and I was a little less grey than what I am now, going back to the olden days, you know, your Vauxhall Corsa and your Vauxhall Nova, I'm really going back in history now, was a pretty cheap car, you know, and the average family could afford that. What we're starting to see, I think, is the premium brands getting to a level where they are at a point where people are questioning whether they can actually afford it, especially in America. The price of trucks, for example, pickup trucks has gone up massively, as it has across the world. So fundamentally, I think the pricing of vehicles is starting to get too high for the average person in the street to afford, which is great because it pushes it to a certain extent onto the used car market, which we talk about if you want at some point. But fundamentally, what that's doing is that's saying, well, can the average person afford it? Question mark. We're seeing with some of the stats that we're seeing out from some of the investment banks that we look at and work with, they can't. And we see that market is starting to peter in the way of price. The price has been very rapid increase, especially since COVID 2020, and the demand for the likes of premium brands, I think, is starting to sort of peter in. And SUVs is coming under pressure because they're clearly more expensive vehicles. So we do need to consider that really carefully of where that price pressure is going to come from. Now, we might, with the Chinese brands, have that pricing pressure after 2025 going into 2026 come down, which I think will enable ultimately the Chinese to have a better chance of getting into the market than what they would have done if the prices weren't so high.
That makes sense. I mean, if we move downstream, there's ZEV mandates expected to introduce more volatility into the market, particularly going into next year. How do you see that playing out for dealers, especially with the challenges you already alluded to of balancing BEV and ICE vehicle sales, but with more pressure of having more BEV going into next year?
Yeah, so there's two parts to this. One is the passenger car bit, and then the others are like commercial vehicles. So let's cover off the passenger cars to start with. The scenario of the passenger cars is next year, as you know, you've got to be 28% of your BEV. Of your ZEV mandate target. Now, the issue around that is there is, as the legacy manufacturers have found, it is not easy to manufacture a battery electric vehicle. So fundamentally, there are a lot of manufacturers out there that will either not be able to meet that target or will struggle to meet that target. Okay. They may meet it through credits and whatever, but fundamentally, which is what they've done in 2024 with the 22%. But fundamentally, the big question mark, and we've seen this from Stellantis, it's public information, it's not secret by any means. The scenario is, if they can't meet that, then what they will do is they will sell less internal combustion engines. So let's put that into a bit of perspective. So we said if there's 100 vehicles in total in the portfolio of a dealer, 28 of those has got to be battery electric. What happens if we take out 9 BEVs? Then the scenario is you're probably going to take out between 25 and 30 internal combustion engine vehicles. So you're selling probably 25 less vehicles, if not more, than what you're doing now out of 100, of a pot of 100, right? and that's quite substantial for a motor retailer. That's a
Yeah.
lot of operationally gearing into the business.
Yeah.
Now, if you look at the light commercial vehicle market, that's even tougher, because at the current moment in time, BEV sales on vans, light commercial vehicles, are not that great. The targets are not as high, but fundamentally the charging network, the cost of it, and so on and so forth, is still not there for the light commercial vehicle network either. So there's big questions over how we're going to get around that. Could well be selling less internal combustion engine vehicles for LCVs as well.
Yeah, no, that makes sense. And then maybe just looking at the used car market, and vehicle supply is clearly being constrained by the drop in ICE vehicle availability. But what ripple effects do you foresee for the used car market going into 25? A harder market in terms of tighter supply?
There could well be a tighter supply if the scenario is that people can't get vehicles. We're not quite back to, by any means, we're not back to the COVID era.
No.
Although that wasn't far away, and that's still affecting us now, of course, because we're still short of those 2 to 3 million units that we didn't get between 2020 and 2022. But I think fundamentally, if the OEMs are going to say, well, you're not going to have internal combustion engines, then it could put a situation where you could have a shortage of supply, and those type of vehicles could become scarcer in demand, could be scarcer than say the battery electric vehicles. Of course, don't forget, what you're getting is, when you buy a new vehicle or you sell a new vehicle, you get a part exchange in replacement of that. So there could be a situation that not so many internal combustion engine vehicles coming through. So that could have pressure on the supply chain of used cars.
Yeah, sure. And then after sales is another area under pressure due to the decline in 5-year-old vehicles. What do you foresee that meaning for franchise dealers, independent garages, and the body shop market next year?
Yeah, so what we've seen for under sub 5, what we call sub 5 vehicles, those from 0 to 1 to 5-year-old, is they've dropped about 25% from 2019 to 2024. And you can see that with the Auto Trade stats from Ian Plummer and the guys. So pretty good research. So I'd recommend anybody to go and see that. But fundamentally, what you're seeing there is that's going to hit your after sales. Now, the big question in your after sales is, that's where your gross margins are really very powerful. What do I mean by that? I mean, on your average labour sale, you'd have 65 to 75% gross margin in your after sales. So it's really a very, very profitable end of the business. If you're not selling your labour, you're not selling your parts. So, your 15 to 20% gross margin on your parts is, again, going to be your question mark. So fundamentally, you've got to be out there fighting for every single, potential service, repair, and whatever the case may be. In the way of the body shops, we've seen in 2024 a reasonable drop as well in body shops and claims. So, the level of demand at the moment to the level of supply is probably, okay. It's not bad. We are starting to see, less pressure in the way of, cars with ADAS, LiDAR technology, and less crashes that is taking place. So that will increase over time. So, we can see why, to a certain extent, there's consolidation in that market. But fundamentally, the 0 to 5-year-old is going to also impact that market as well.
Yeah. And finally, as we've alluded to, dealer margins are being squeezed. There is pressure on dealership valuations at the moment as well. What do you see as the opportunities for consolidation in 2025? Or do you think near-term challenges will dominate that?
I think at the moment, near-term challenges are probably going to dominate that. Your average dealer is going to be, well, I need to get my house in order. I need to make sure that the used cars and new cars are selling as well as they can possibly sell. I need to ensure that my efficiency, my upselling, the after sales is absolutely maximized out to its absolute opportunity. So ensure that basically your sales advisors, which is the unseen and unsung hero in the back, basically got are absolutely fully trained. So they are getting everything they can out of that. And again, your parts are efficient. You're not got obsolete stock. You shouldn't have obsolete stock anyway. Keep your stock in your vehicles to a minimum. In the way of consolidation, I think there'll still be consolidation. I think people will still be buying around the edges. And I think that, there may be a little bit of a delay of people buying, people looking and seeing how the market settles down a bit. But I think we could see the opportunity of some international players coming in and going, actually, assets are probably cheaper now than what they've ever been before. So with the exchange rate benefit, you could see the international players coming in quite effectively, you know.
No, it makes sense. Well, Owen, as always, your insights are really valuable. It's clear that 2025 will be a challenging yet pivotal year for the UK automotive market. I guess what we've discussed, from upstream issues like supply chain fragility, BEV production, to downstream pressures on margins, used vehicles and after sales, there's no shortage of complexity going into the market next year. But I guess to me, what's clear is being flexible, cash flow management, forward-thinking strategies will be key for businesses navigating this environment. So thank you for joining us. And I guess we'll have detailed show notes where people can get hold of you. But any closing comments and what the best way to get in touch with you?
Yeah, so basically at the end of the day, if you want to get in touch with me, it's not a problem. Feel free to go to my GT web address. It's owen.edwards@uk.gt.com. Feel free to get in touch with me on anything. What I would say is, at the moment, there's a difference between grip and vision. So vision is that strategy. Grip is you've got to get a hold of the company. So at the moment, we'd be putting your grip and vision perspective on your business to be probably more like 60 to 70%, where historically would have been at 50-50. Look at your vision. It's come in. But you've got to keep one eye on that. But the real big eye you've got to keep on that, on your business and what you're doing now, to ensure, as you quite rightly said, Mike, cash flow.
Excellent. Thank you again, Owen, and we'll catch up soon.
Well, thank you.
If you want to listen to more episodes of the podcast, we're on all good audio platforms. Our website is also www.cambriaprivatecapital.com. And you can also find myself on LinkedIn and Twitter, where we publish our weekly blogs as well. Please do get in touch if you want more information.